Crypto arbitrage is a strategy where traders exploit price differences of cryptocurrencies on different exchanges to make a profit. Here's a concise guide. 1. Research. Begin by researching various cryptocurrency exchanges. Look for price disparities, fees, and trading volumes. 2. Select coins. Choose the cryptocurrencies you want to trade. High market cap coins like Bitcoin and Ethereum are often good options. 3. Create accounts. Sign up and verify accounts on the selected exchanges. Ensure you meet KIC-AML requirements. 4. Fund accounts. Deposit funds into each exchange. Be mindful of deposit and withdrawal fees. 5. Monitor prices. Use trading tools and bots to track prices in real time. Look for significant price gaps. 6. Execute trades. Buy the crypto at the lower priced exchange and simultaneously sell it on the higher priced exchange to lock in profits. 7. Consider fees. Account for trading fees, withdrawal fees, and transfer times. Make sure the profit covers these costs. 8. Security. Implement strong security measures to protect your accounts and funds. 9. Risk management. Be aware of the volatile nature of cryptocurrencies. Don't invest more than you can afford to lose. 10. Tax compliance. Keep records of your trades and report any taxable income to comply with tax regulations. 11. Continuous monitoring. Crypto markets are 24/7. Continuously monitor price changes and be ready to seize opportunities. 12. Exit strategy. Remember, crypto arbitrage carries risks, and profits are never guaranteed. It requires swift execution, constant monitoring, and a good understanding of the markets. Always do your due diligence before engaging in arbitrage trading.